Hey guys, it's Jim Ryder talking a little bit about what makes mortgage rates go up and down. A lot of people think it's the Fed. So the Fed is raising what's called the federal fund rate. The federal fund rate, that does not impact long-term mortgages like 30-year fixed, 15-year fixed mortgages. That impacts short-term money. Short-term money would be your credit card interest rates, they're going to go up. Lending on automobiles, credit card, like cars, that's going to increase. Lines of credit on your house, which is variable, those have been going up like crazy. Mine used to be 3%. It's almost 8% now because the government raised the rates 5% in the last 12 months. So short-term money, okay, or variable interest rate money is more expensive. That's tied to that federal fund rate. So when you hear that the government is raising interest rates, that is tied to the short-term money, federal fund rate. Sorry about that. Okay. Long-term interest rates, 30-year fixed, 15-year fixed, that's tied to inflation. What's inflation? I'll give you an example. Inflation is if you went to Dick's, like our family's a sports family. If you went to Dick's Sporting Goods, okay, and you bought a basketball, let's say you bought a basketball April of 2022, and it was $10, and you go there today, April 2023, and it's $11. That's a 10% increase in price. So the inflation number year over year from 2022 to 2023 would be a 10% inflation rate. During the pandemic, when it was hard to get goods, okay, there was lack of goods and you had all this free stimulus money, the prices went way up. And we were at 7, 8, 9% inflation. The economy's not healthy when goods are going up that fast, okay? It's going to price people out of the market unless you're rich. So anyway, without getting off topic on that, what impacts the rates is inflation. So what's been happening is in order for the government to combat inflation, okay, to bring it back down, so it's a supply and demand. If people are willing to pay more for a good, okay, then that good price, the price of that good is going to continue going up. When you raise the price or the cost of borrowing money to buy that good, when it gets to a point where it's unaffordable, then you're going to have less demand. When you have less demand, that's when inflation comes down because prices will start coming down, and that's how it works. So when the government's raising the federal fund rate, that is not actually increasing or decreasing interest rates, okay? It's inflation. And what we're seeing is that the government yesterday just raised the lending rate, which is that federal fund rate, 0.25%. So if you have a line of credit, if you're going to buy a car, if you have your credit card, if you look at the interest rates, they're actually higher now by 0.25% because it follows the federal fund rate. What we're thinking is that going forward in March, April, May, June, what we're going to do is we're actually expecting the inflation number to be better than it was a year ago. So let me explain how that works. If you go and look at the inflation number April 2022, okay, and when the inflation number comes in for 2023, which is going to be in 2 or 3 weeks, we expect the inflation for that month to be lower. And so for instance, if you're taking a 12-month average, when the April 2023 number comes out, then the April 2022 inflation number drops off, and that's not part of the 12-month average anymore. As we see the April and May and June of last year, which is very high inflation numbers, once we see those drop off and we see the lower inflation numbers as part of that 12-month average, we believe, or I believe, that interest rates will fall this summer. How far? I'm not sure. There's no crystal ball, but because rates follow inflation and we project the inflation numbers to be better in April and May and June, if I'm right and if the projections are right, then interest rates are going to drop, and that's going to create more buyers because as rates drop, more buyers can afford the homes. My opinion is if you're looking to purchase a house, now is the time to start looking at the homes and making offers. It's still competitive out there, But let's just say for how competitive it is, it will only become more competitive and harder to go under contract because there's going to be more buyers out there. So I just want to throw this out there, let you know a little bit about, what makes the rates move, which is inflation. The Fed increasing the federal fund rate does not directly impact mortgage interest rates. The Fed is only raising rates because the inflation numbers are very high. They're trying to bring them back down. If the inflation numbers drop in the next 2 or 3 months, mortgage interest rates are going to drop also. There's also going to be more competition because as rates drop, there's more buyers that come out of the woodwork that want to purchase. My last thought, okay, because I'm all over the place. I didn't write any notes down. This is just I'm ad-libbing big time. Is that if you buy today, okay, with less competition, with a little bit higher interest rates, you'll have the house that you want. When rates do turn and they drop, you can refinance, which is basically just pay off your current mortgage at the higher interest rate with another mortgage, okay, at the lower interest rate and drop your payment. So if you're out there and you're thinking, is today a good time or is now a good time to purchase? Because, all the national news say there's going to be a recession. There's not. Okay, now's the time to purchase. We can refinance you down the road and lower your payment. But if you're looking for less competition, now's the time to purchase. Thank you for watching. And if you have any questions, you can go to jimrider.net. That's my website. It has a lot of great information, useful information. So I want to help. Or you can call me directly. I'm always available. If I don't answer, I'll call you right back. My number is 860-287-1603. But again, jimrider.net. Thanks.